Well, joining me now for a look at the local markets, Kimon Boyiatjis, CIO at Trident Capital, joining us from Cape Town. Kimon, thanks for joining us. And of course, you've got the shot of Cape Town Table Mountain behind you. And I've just come back from climbing Kilimanjaro, which is certainly 4,000 meters above Cape Town's height, or even 5,000 meters, I think it is. But that being said, Kimon, let's get to the markets right now. Tell us about your views on the local equity market, because a bit of a pressure coming through on the resource front, weighing down on the overall market. But resources have been so volatile and really difficult to say from any one day which direction they might go.
Well, we haven't been a big fan of the specific miners over the past 6 months. We prefer to say with the diversifiers, the BHP Bulletins of this world and Anglos. Having said that, I think the overall equity markets internationally have been running strong. We've been anticipating that well into the first quarter and possibly even a little bit further. I think what's also significant is what's happened in Europe recently with regards to the Cyprus issue. If the banks or governments can actually just take money out of people's accounts, or there's the threat of that, at least the danger of that. I think fewer people want to have their money in the banks, and I think some of that concern might persuade investors to go and put their money into the equity markets. The international bond markets look pretty stretched right now and quite expensive, and I think the risks are high there. So I think this bodes well for the equity markets, perhaps for another spurt upwards. It's just another reason why people are buying equities.
I mean, it certainly seems that the whole Cyprus effect it seemed to be waning today, and people choosing to focus back on, I suppose, what really does have systemic risk for the overall Eurozone region and the global economy. Let's turn our attention to the Federal Reserve policy meeting later this afternoon. Do you think the world is too obsessed around the timing of quantitative easing ending, given the fact that Ben Bernanke has given the 6.5 unemployment rate target?
I think they're correct to be a little bit obsessed about it, but I don't think it's going to end now. There are too many unknowns. I think the world economic growth isn't at a level where they can take their foot off the gas. So I think it's much of the same for longer. I think what they'll try and do is keep US bond rates low for longer, and I don't think we're going to see a shift in policy right now. I certainly don't think we're going to see it in Europe. So anticipating, again, no change in what we've seen at the FOMC in the past. I think it'll continue to be much the same going into the future. So at least into the short term, next quarter or two. So I don't anticipate any changes there, no.
I mean, if you're looking at all of these questions, and of course gold often linked to issues around monetary policy and interest rates, and of course hedging against this low interest rate environment, what's your view on the gold outlook right now, given the fact it hasn't really gone anywhere this year, and it seems that with more risk appetite in the market, it's actually been a factor that has held back the gold price this year?
Well, I think you should always have it in your portfolio, minimum 5%, possibly even 10%. But the one thing that gold does do, in rand terms, it's certainly gone up. Maybe in dollar terms, it hasn't. Again, if you're a euro holder, it's gone up in euros as well. So it is a safe haven. I'd also believe that is one place to have some money locked up in a vault somewhere, physical gold. So you can't get the government taking anything out of your bank account there. But nonetheless, I do think it's important to have it as an investment. Whether it's 5 or 10%, I think that should be the range that investors should be looking at. But again, I stress it's physical gold and not the gold miners. I'd much prefer to be a hold of the physical. So with that in mind, equity markets look okay in the short term. Again, I must stress that it's probably worthwhile having some inflation-linked bonds. And I agree with Peter Worthington with what he said earlier on about the inflation rate. I don't expect a sudden pullback. I'm in agreement with him. And I certainly do think that what we're going to find is that it certainly will breach the upper limits of the target bands.
Are you concerned about the impact that concerns around the South African economy, concerns around funding the government's spending plans are going to have on bonds going forward? Because speaking to the fixed income analyst earlier, she says she doesn't really see a further depreciation on the bond side of things, especially on the long end, in fact, anytime soon.
Well, I think you've got that the yield is probably at fairly priced as we stand right now in terms of the long end. You've certainly got international investor appetite for it if they can hedge out their currency risk, which that's quite expensive actually to swap it out. But nonetheless, I think they can lock in some decent rates. I think some of the bonds offer value for international investors. Local investors are underweight bonds anyway, so I don't think there's much selling that we're going to see from the locals. But if I had to take a long-term view, would I like to actually own bonds at current levels? Only for a couple of quarters and not looking forward 1 year. I think they're important. I think they should be part of any portfolio. But again, I do anticipate a bit of a kick up in the back end, meaning the longer term bonds are not where I would prefer to be. I'd rather remain fully invested up to 10 years.